So, three questions I've been receiving a lot, and we're talking about multiple times by different investors. The first one, and while talk a bit about that, we can actually show our first chart, which is the S&P 500 year-to-date chart. And this would show with good reason why investors are getting nervous. They're getting nervous. They've been getting gradually more and more nervous over the last, let's call it, month and a half or so. The first question, as we look at this chart, is from many individuals that are approaching retirement or just entered into retirement. They ask me, or they state the same thing: Allan, I don't have enough time to weather a downturn in the market. My time horizon is a lot smaller. What can we do because I don't have enough time to make back any losses? So that's the first comment or question I get. My answer is very simply, you do. As you move into retirement, from what I've seen in my 26 years, I have not had the experience where an investor pulls out all their money out of their investments all in one shot to live off of. You may pull out 30,000, 50,000, whatever you need, 100,000 to live off of, but the rest of your money stays invested. So if you're pulling out 3% of your portfolio, 4% of your portfolio, the hope for many investors is that whatever's left in the account after you withdraw whatever you need monthly, quarterly, annually, is that money or those investments can make back what you pull out. And so your portfolio either stays the same or maybe even grows a little bit while in retirement. Maybe that RSP that became a RIF or RIF account at 72 now actually grows a little bit over time. Because as I said, you're never going to need all your money at once unless you're saving for a house or something specific. Most individuals, if they're saving for retirement, when you actually retire, 65, whatever that age is, you need some of your money and the rest of your money stays invested. So if we do experience a downturn in the markets, you are going to be invested for the next 10, 20, 25 years, depending on obviously how long you live. And as I tell people, you're going to invest until the day you are no longer on this planet, till the day you're no longer with us. That is, hopefully you start at a young age, maybe in your early 20s when you get your first job, and you'll be investing well into your retirement. So you do have the time horizon to make things back. So this talk about as you get older, the more you should have in fixed income. Yes, I think that can make sense for certain investors. But for other investors that need growth and more growth, that doesn't make sense. You should be asking yourself always, what do you want your money to do for you? That is a lot more important, way more important than following some rule of thumb that says you should have more bonds in your or GICs in your portfolio just because you're a year older or a few years older. That doesn't make sense to me. You always want to ask yourself what you should be doing based on your investment objectives and goals. If it's growth, well, you can't be in GICs or bonds making 3%. After inflation and taxes, you're not making anything. In fact, you might have a negative return. So always ask yourself, what am I supposed to be doing, or what do I want my money to do for me? And that's how you should be investing. So that's question number one, or comment number one I get most often. The second comment or question I get, and that we can go to our next chart, is basically this idea of when markets are volatile, why don't we take a step back, Allan, move ourselves from the market until the coast is clear, and then we can go back in. Knowing when to get back into a stock, for example, is never easy. That's the title of this chart. And here we have a perfect example of a situation like this. And I'm using today's environment to prove a point here that it is never easy knowing when to buy back in. We could all say, okay, stock goes down, let's sell, take our profits, and we'll get back in later. Well, when is later? When will the coast be clear? When will the storm clouds all go away? Well, I'll tell you, they never all go away. There are always reasons or storm clouds on the horizon for people to be nervous. Some people are nervous when the market goes up because they know that at some point it's bound to come down. So that prevents them from investing. And some people get nervous when the market goes down because it's a pretty negative feeling that there's something wrong in the economy. That's why the market's going down. So fear grips them on both ends and they never invest. So here's a pretty quick example. You have investor A and B. They own a stock. We called it XYZ. And here you have on the left, it goes from $0 to $20. So both investors, investor A and B, are up to $20 a share. Now, unfortunately, due to markets, the potential tariffs that we're hearing, slowdown in the economy perhaps, stock falls from 20 to 15. That is our next dot right there. Investor A decides to take his profits at that point and sell, even though it's a 25% decline and obviously down a lot from the high. They want to take their profit because they feel that that's what they should do out of fear, out of panic. Well, what happens? We continue to have the ups and downs of the market, and the market falls down to a price of $12. It continues to fall, as you see on our next dot on the chart. And at that point, investor A tells investor B, you see, you should have sold. I saved myself another 15%. Okay, fast forward a little bit ahead, and all of a sudden we start to hear that a rumor, maybe there are some trade negotiations going on behind the scenes between the US and Canada, between the US and China, US Europe, or anywhere else, US Mexico. And all of a sudden, just based on the rumors alone, and we've seen this happen many times, stock goes from 12 back to 15, maybe takes a day or two. And now all of a sudden, investor A and B are roughly at the same point. But investor A has sold at $15 a share, whereas investor B is still holding the stock. So investor A is out of the market. Investor B now is sitting there going, well, I'm no worse for wear. This is an important part of this chart because if investor A were to get back into this stock before the price goes back up to 15, then selling at 15 would have been a great move. Very smart move, perhaps a lucky move. But if they wait too long and they wait till that stock goes back to 15, if it does, then they're no better off. And in fact, now you have the next part of our chart where stock goes back to its previous high because trade talks are actually now confirmed. It's a confirmation that President Trump has now spoken to Prime Minister Carney or whoever's in power in Canada at that time, the end of April. And now the trade talks are confirmed with Mexico and the European Union, and it looks like things are progressing. But every day, of course, there's a different headline. It's progressing, it's not progressing. So investor A, again, is like, well, maybe I shouldn't jump in because how do I know this is not a head fake? Investor B is along for the ride, and now the stock is now at $20 a share, back at its all-time high. The last part of our chart is kind of the point where agreement is now in place. The United States and Canada come to some sort of trade agreement. The United States comes to many trade agreements around the world. The stock jumps up from $20 to $25. And now investor B looks back at investor A and says, why'd you sell? And investor A says, well, I was nervous. I saw a lot of negativity. I saw a lot of storm clouds on the horizon. And so I panicked and sold when that wasn't the right thing to do. Stock XYZ turns out is a fantastic company, good quality company, best in class name, should be a name that you could hold through the ups and downs. However, let's say you're an investor and let's say you decide to sell at $15, but let's say instead of removing your money from the market, you move into a new name, perhaps a name that has dropped in value. And this is important because this is what I try to do. If I have a B class name, I can maybe move it to a A-class name, a better quality name that perhaps has fallen more. So instead of coming out of the market, you go into a better quality name once you sell, in this case at $15, and now you're in a better quality name, but you're still in the market, which is important because when things get better, and they're going to get better based on, in this case, political reasons, nothing to do with the individual stocks themselves, just the environment gets better for trade. And that spills over into the stock market, the good feeling between countries, and the stock market runs higher. And with that, a stock runs higher with it. So getting out of the market, in my opinion, is the wrong thing to do. If you want to sell to upgrade into something else, that makes sense because you're still in the market and you can still ride this wave higher. So the second comment I get is, can we sell? Should we sell? And the answer is no. If you're in the market for growth, and if you know that you're selling because to get back in later on, then I wouldn't be a seller. If you're selling to remove yourself totally out of the market and never go back in, that's a different story. Perhaps you have enough money to live off of in retirement, and you don't need to look for growth in your portfolio. Then maybe you could sell and stay out of the market. But it's getting back into the market. That is the most difficult thing to do. And our third and last question that I get and have been receiving most often is this whole idea of trying to look for Canadian investments versus U.S. investments. Should I be selling my U.S. investments and moving into Canadian ideas? And my answer to that is no. I don't think that's a good recipe for success. Canada makes up 3% of the world's markets, whereas the U.S. makes up 20+% of the world's markets. How much money is in Canada versus the rest of the world? And so with that, a lot more opportunity to make money outside of Canada than inside. Now, I'm not saying to have only global investments. I'm saying you need a mix. Maybe you have some inside Canada and a lot outside of Canada, based on this idea that there are a lot more ideas to find in the US and definitely other parts of the world. Before we move on from our first segment, I think we have our best chart of the show, and let's put that up. Timing the market. And this is something, again, talking about selling to get back in. And here you have value of $10,000 invested in the S&P 500 for the last 20 years between 2003 and 2022. You see at the bottom, what it says is if you've invested all days, didn't pull your money out of the market, your $10,000 would grow to just under $65,000. If you missed just the 10 best days in the market, just 10 days out of over 3,000 days, your return would be cut by more than half, 29,708. And then the illustration keeps going. You missed the 20 best days, 17,826. Missed the best month or 30 days, $11,700 as compared to 64,800. And then it goes on. If you missed the best 60 days, well, your 10,000 ends up being worth 4,205. So you start getting into loss situation. So understand that just 10 days in the market in 10 years can mean so much to your portfolio. You ask when those 10 best days come? Well, 10 best days usually come when after the 10 worst days. So at the bottom, you see when the 10 best days came. 2008, October 13th, October 28th, 2008, during the height of the financial crisis. 2020, March 24th, COVID. March 13th, COVID, 2020. Again, March 2009. That was the bottom of the financial crisis. The market took off from there. So if you were a seller at that point, boy, were you upset. And then you can see all the dates, April 2020, November 2008. And there you have it, right? The best days came at the worst times. So if you are fearful, you're never going to be in the market during these days. You have to stay the course, stay confident, continue to own best-in-class names. To me, that is more important than trying to figure out, should you get out of the market? Should you buy Canada versus US? Just buy quality. Buy quality, and you won't have to worry about your time horizon. If you need growth, if you're looking for growth, you could still have growth in retirement. Everything doesn't stop when you turn 65 and retire. You still have money invested year after year that needs to be invested wisely in good quality investments. So those are the three things that I've been asked most often. And hopefully, if any of you have had these questions on your mind, hopefully I've answered this question for you today as well.